Well, hello and welcome to this live webinar. Today we're talking about diversifying your income in the current environment. Of course, I'm Peter Switzer. Thanks for joining us. To talk about what this actually means, I'm joined by Joye and Ying and Cheng of Coolabah Capital. Now, Coolabah is a leading bond and fixed income manager who manages over $4.5 billion worth of assets on behalf of institutional and retail investors. I'm talking about the big end of town. Thanks for joining us, guys.
Thanks for having us, Peter.
Now, before we go any further, I should just say that this is a live, interactive webinar, so please submit any questions that you have, and we'll aim to get them at the end of the session. You can enter a question by clicking the Q&A button at the bottom of your screen. There should be also the button to raise a hand at the bottom of the screen. If you would like someone from the team to give you a call after the session, please click Raise Hand, and we'll get in touch with you once the webinar is complete. Now, I'm excited to say that Coolabah has recently been appointed as the manager of the Switzer Higher Yield Fund, which is being relaunched as a quoted vehicle. That means you can get it on the stock exchange, and we're currently running an initial offer period for the relaunch of the fund. And I've got to say, personally, I love my name being associated with these two guys. I think they're some of the smartest people in the country when it comes to financial markets, and I quite frankly like my name being associated with really smart people rather than dummies. So guys, thanks for coming on. Here's a couple of questions I want to throw to you before we kick off. Before we get into the new fund, tell us about your outlook for interest rates and the Aussie economy more broadly in 2021.
Well, thanks, Peter. Yeah, we're very bullish next year. We think growth will be very strong. But importantly, I think the RBA will absolutely keep rates at their current level. And in fact, we think that the RBA will expand its bond purchasing program. It's committed to buy $100 billion over the next 6 months. And we think they'll commit to buy another $100 billion over the following 6 months. They're buying federal and state government bonds. They're bidding them up, pushing their prices up, and targeting to reduce the yield on those securities. In the Switzer Higher Yield Fund, we actually have a quarter of the fund in bonds that the RBA is buying. So hopefully the portfolio will benefit from ongoing QE. But as I said, very constructive about 2021. We're getting vaccines as we expected. In March, we had the view we would get vaccines that would work, that would be approved, and that would be distributed this year. We're also very positive on housing. We think house prices will rise by 10 to 15% next year. But importantly, Peter, house prices today are still lower than they were in 2017. So we don't see any signs yet of a bubble emerging.
Okay, let's go to the actual bond market itself and how it might perform in this economic environment.
Yeah, I think we look at the bond market as many different asset classes, Peter. So you have government bonds, bank bonds. Within bank bonds, you have senior bonds, so-called tier 2 bonds, and hybrids. And then we obviously have corporate bonds. So there's a panoply of securities. We're quite constructive on 3 sectors right now. We're positive on the state government bonds that the RBA is buying. We're positive on tier 2 bonds, which have quite high yields, and we think they will benefit from that search for yield. And we're positive on hybrids. Ying, do you want to just quickly talk about our thoughts on the hybrid sector and why we think that can continue to perform, notwithstanding the fact that we've actually had 5 recent hybrid transactions that have created a little bit of sogginess in the market. Yingers?
Yeah, sure, of course. So if we look at hybrids, and I think, we need to also consider what's also happened to other parts of the capital structure for the banks. So if you look at bank senior bonds, so major bank senior bonds, They blew out from circa around 75 basis points in March, so 0.75% say over the bank bill swap rate in March, and they blew out to circa around 180 basis points or 1.8% over the bank bill swap rate. Now they have since compressed to inside of pre-March, so pre-March levels, and they are now trading at post-GFC tights. If you look at hybrids, they were trading around 270 basis points over the bank bill swap rate, like pre-March, pre-COVID. And they blew out to 800 basis points, so 8% over the bank bill swap rate. They've mean reverted or normalized. However, they're still trading currently around 320 basis points, 330 basis points or so. So they are still wide of their pre-COVID levels, and they are definitely not at their post-GFC tights, obviously. So given how bank senior bonds have performed, then we see a lot of alpha runway or degree for capital gains. Capacity to generate capital gains from those same sort of bank hybrids as well.
So are you guys saying then that that margin in the hybrids will fall as this growth that Chris talked about kicks in and a more boom-like economy comes around, more like the pre-COVID economy, even better, and that then will compress that yield you're talking about?
Yeah,
Yes.
I think that's right, Peter. We have unprecedented fiscal and monetary policy stimulus. In March, we projected the unemployment rate would quickly settle at 6 to 7%. As you know, it's currently at 7%. The consensus view was much more pessimistic. So pretty much everyone in the market thought it was going to 10 to 12.
Except me, by the way, except me, Chris. But go on.
That's right, Peter. That's right. I think you've been similarly sanguine. But I think the portents are extremely promising, apropos the prospects for a big boom in 2021 economically. I think in respect to the hybrid market more specifically, as Ying has mentioned, spreads pre-COVID were at about 260, 270. I think they actually got to 260 over bank bills. They blew out to 841 over bank bills. They actually came into about 307 basis points. And then because we had those 5 hybrid deals, including deals from NAB and Westpac, spreads blew out actually to about 340 basis points. They've come into 320, 330. We think those spreads will compress back down to 260 minimum, which will give us potentially capital gains of around 3% on top of the income paid by the securities. And in fact, back in 2007, major bank hybrids were trading at about 1.25% above bank bills or 125 basis points above bank bills. Whilst the securities today are a bit different, the banks are much, much better capitalized. So CBA's equity ratio, which is equity divided by its assets, in 2007 was about 4.7%. Today, it is around 12%. So like high 11s.
Better risk. They're better risks, aren't they now?
Yeah, so they've actually radically reduced their leverage since 2007, which is very positive for hybrid holders. And APRA has actually just released today, as I'm sure you know, Peter, a paper on their stress test results of the Australian banking system, showing that they're exceedingly well capitalised. March 2020 was a huge stress test. This is the biggest economic shock we've had in more or less 100 years. And the banks, as we know, fared incredibly well. So I think that there'll be more hybrid supply. In March, we'll probably get Macquarie, or in Q1, Macquarie will probably refinance one of their existing hybrids that's due to mature in March. A little bit of sort of inside the beltway, goss, I guess, on this subject is that there is a $2 billion hybrid called NAB-HA, and NAB has hinted that they might repay that security. We think they will sometime in February. And so that will be $2 billion of cash coming back into the system. So we think that we've had 5 deals come to market. That's a lot of supply. We think spreads will compress. We think we'll get capital gains out of our hybrids. We also think our Tier 2 subordinated bonds will perform well, which we have in the portfolio, also issued by the major banks. And as I mentioned, we like state government bonds.
Okay, so we're working together on the Switzer Higher Yield Fund, as you know. Can you tell the audience who are watching right now a bit about the new fund?
Yes, we can. So the Switzer High Yield Fund is targeting 1.5 to 3% above the RBA cash rate, which is a fairly chunky margin when you think about it. Like you're struggling to get a return on a term deposit today of 0.5%. So we're targeting 1.5 to 3% above the RBA cash rate. We run similar strategies to this fund for clients, and we've comfortably beaten those benchmarks after fees since inception. We're targeting a running yield of 2 to 3%. We want to, and actually, maybe Ying, you could just share the slide on this. We have a single slide on the Switzer High Yield Fund, but we want to target a running yield of about 2 to 3%. And yes, that's the slide. Thanks, Ying. We're targeting volatility of only about 1.5%. Now, to put that in context, and I guess it begs the question: what is volatility? Volatility tells you how stable or otherwise the returns are. So the equity market has volatility of about 10 to 13% per annum. Bank stocks are at about 20% per annum. So we'd all be familiar with the idea that, in March, the share market fell 21%, bank stocks fell 25 to 35%. And this portfolio is targeting volatility of about 1.5% per annum. Again, the existing portfolios that we've been running that are very similar to this for the last decade have displayed that level of volatility. We're targeting a strong credit rating in the A band, daily liquidity. There'll be quarterly distributions. As a quotable fund, what that means is it's quoted on the ASX, so you'll be able to buy and sell units on the ASX. We should have 50 to 100 active positions in the portfolio. We won't have any interest rate risk. What that means is it will be a floating rate portfolio. So heaven forbid if the RBA ever increases the cash rate, the interest rate on the portfolio should rise in lockstep with that. And that's important because in the bond market, if you invest in a fixed rate bond rather than a floating rate bond, if interest rates rise, the bond price will fall. With a floating rate bond, if interest rates rise, the interest rate on the bond actually increases and the price doesn't change. So we're focused on very high quality businesses. They're going to deliver these returns. This particular type of strategy is known as a short-term fixed interest strategy. That is at the lower end of the risk spectrum, as I guess evidenced by its volatility. I think as an aside, it'd be worthwhile just talking a little bit about Coolabah, our team and capabilities, and how we generate those returns. Do you mind if I just segue into that, Peter?
Well, I was going to say to you that one of your competitive advantages is that you've been able to find mispriced bonds, and so to be able to do that so well is basically saying that you've got a really smart team who can do it. So I guess you want to talk about your team.
Yes, I might hand over to Ying Yi, and Ying, you can just talk to us about the team, the size of that team, the capabilities, and then I think just quickly jump to Ying Yi, how we generate our returns and how we're not just focused on yield. When we talk about fixed income, Peter, everyone talks about yield, but actually for us, yield's the last thing you want. What you want is return, and we can explain what we mean precisely by that distinction in a moment. But Ying, do you want to talk about the team and just a bit about Coolabah and then our alpha?
Yeah, sure. So collectively, Coolabah is running more than 4.7 billion, so around 4.8 billion, in fact, in funds under management. And we have the largest team in Australian investment grade fixed income. So we have 25 full-time executives made up of 5 portfolio managers, 13 analysts, 10 quants, 5 data scientists, 4 PhDs and 2 university medalists. And so intellectual edge, as we've discussed, Peter, is incredibly important to us. And we have a very strong quant focus as well. So, the data science team themselves are running 30 to 40 different quantitative valuation models. And we also have a very large credit research team. Typical fund fixed income managers might have 2 or 3 portfolio managers and 1 or 2 credit research analysts. And you can see we already also have 5, and the team is growing as well. collectively, across the 4.8 billion that we're running, we run 28 portfolios, so 24 institutional mandates and, 4, about to be 5 public offer funds as well with the Switzer Higher Yield Fund. And for us, I suppose the key point of difference between us and a lot of our peers is that if we look at fixed income as an asset class, I mean, this is true of any other asset class, but if you want more return, investors or managers can give you more risk or they can chase risk. And in fixed income, this can take the form of interest rate duration risk, which Chris mentioned, which means fixed rate risk. So it's like, for example, if you were to fix your mortgage, you're taking a view on where interest rates are going to be over the next circa 3 or 5 years, depending on the duration of how long you're fixing your mortgage. In this case, when investors, invest in longer dated fixed rate bonds, they're giving you that interest rate risk. So you're locked in for that period of time on that interest rate. They could give you more credit risk or default risk, which means investing in sub-investment grade and unrated securities, or they could give you illiquidity risk. So for example, investing in illiquid loans and other illiquid securities. That's fairly easy to deliver and fairly straightforward. You know that when you take more risk, you get a higher rate of return to compensate you for that. What's harder to deliver is alpha. And you might hear that as common, investment rhetoric thrown out by fund managers. But alpha for us is very straightforward. It comes about through capital gains that we identify via finding mispriced bonds and trading. So what is a mispriced bond? Well, it's simply one that is paying too much interest after you adjust for its risk factors. For example, its credit rating, its term to maturity, the liquidity of that bond, where does that bond sit in the capital structure? And if that traded interest rate is above where we see fair value, then we will look to buy that bond, wait for that bond's interest rate then to normalize towards fair value, and then we sell it for a capital gain, much like your active equities manager, but in fixed income. And, we are trading at least 70 times a day, between 100 to $200 million a day.
I think this is important, Peter, because again, in fixed income, you basically have two choices. You can chase yield and load up on risk, or you can try and apply serious skill and find these mispricings and get capital gains that substantially augment that yield. I want to show you one other screen. Ying, if you could just bring up the trade by trade analysis. And thus far, again, Ying mentioned rhetoric. It's quite common for fund managers to say, listen, we're smart, we're successful, and we can deliver high returns and furnish alpha. What we're looking at here is our internal quantitative lab, and this covers all the portfolios we currently run, as Ying mentioned. I would say, Peter, you mentioned the partnership between Coolabah and Switzer, but we are likewise proud to partner with you. So thank you for the opportunity in terms of competitively selecting Coolabah in that tender process to serve as the investment manager for Switzer in the context of the Switzer High Yield Fund. What we're going to show you here on this screen is the profit and loss on every transaction we've ever done. And we're going to cover all sectors of the bond market across all portfolios. We're going to cover all currencies, all parts of the capital structure. So from senior bonds all the way through to hybrids, all time intervals, all credit rating bands. And you're going to be able to see this very visually. Ying has just hit update. Thank you, Ying. And she's just going to scroll down, and what you'll see pop up live is effectively our realization track record. And on the horizontal axis is time. So back in 2012, when I was a relative pup, almost a decade ago now, sadly, there were 2 portfolio managers and 2 analysts at Coolabah Capital. Today, Coolabah, as Ying mentioned, has, I think we're coming up to 26 staff, 13 analysts, 5 portfolio managers, 4 PhDs, 2 university medalists. Every black dot is a bond sale.
Chris, let me just interrupt you for 1 minute, because I know there'll be some normal people out here watching this, and you did mention like the horizontal or zero line. I think the most important message for people to look at this chart and see all of those black blobs above the zero line indicate you've got it right and you've made money, right? Anything below have been the odd times when you've got it wrong.
Correct. So that you're exactly right. And Peter, once upon a time, back in the dark ages, probably in the 1800s, was a professor at a university. So he's not just a pretty face, I should add. But on the horizontal axis, Ying is hovering over, as I'm talking, different bond sales. And what that will bring up is the data. So on this particular sale that she's hovered over, this CBA security, we own 28.01%. That's not an annualized return. That's the actual return we banked. But the red dotted line, you're right, Peter, is the zero return or the break-even line. Above that line are positive returns. Below that line are losers. And if you just slightly scroll down, Ying, very slightly, so we can bring up the table of data. There's some a bit more Ying, please. There's some data underneath that table just there. That's good. And if you just highlight what we call the total return win rate of 98.1%, what you're going to see there is our hit rate. This number tells us what percentage of the time do we make money and what percentage of the time do we lose money.
You're nearly like the Don Bradman of the bond market, mate. A number like that.
Your words, not mine, mate. I'm just a humble grinder.
You love it.
Trying to eke out.
Don Bradman of the bond market. Well done.
But this 98% win rate, it covers quite a lot of bond sales. So if we go to the number of sales column, you can see that you're actually looking at right now 16,864 bond sales. The total value of those bonds, if you go to the far right-hand column, is actually $17.6 billion. The average credit rating on the far left-hand side is A+. And the key message here is this is a very consistent alpha generating process. It's not like we've had a big swing and we've got a handful of winners. There's thousands of winners and it's very consistent. And what's pretty cool, actually, that one thing we focus on is not our overall hit rate, but the percentage of time we're getting capital gains. You can see that's 88.1%, but that covers the last decade. If we hone in on a more recent period, so say 2019-1-1 Yingers, please. I call this the Ying effect. Yingers is really the brains. She's got 99.95 on HSC, distinction average at university. I'm the brawn. The truth is the team's much bigger than Ying and I, as I mentioned, 25 plus executives, full-time executives. But if you look at the capital gain hit rate since 1 January 2019, and you just highlight that, 91.7%. So it's gone from 88% to 91.7%. So we've been getting better. And if we go to 2020-1-1, so what's happened to the capital gain hit rate this year? Obviously, we've had this 1 in 100 year shock in the form of COVID. That 91.7%, I'm hoping will lift up to 93 point something. Yeah, there you go, 93.3. So as the team's got bigger, we've got smarter and better, and we're generating superior returns. And the average credit rating Ying is highlighting is actually AA-. And in the last 12 months, we've actually had some of our best returns ever, despite the fact, Peter, that bond yields have been falling. So I often get asked the question, if yields are falling, Chris, surely you're recutting your return expectations, right? Surely you're going to have to shift the return goalposts. And it is sometimes true of floating rate strategies that you've had to downgrade those expectations. But over the last 12 months, we've had some of our best performance in years. And I really believe that's a function of the fact that we're reinvesting in the capability. Ying mentioned we're expanding. I'm hiring for another trader/portfolio manager right now. We're in the market for another analyst. So we've got those folks spread across London, Sydney, and Melbourne. Actually, 2 offices in Sydney. We're in 1 Blythe Street right now. We also have an office in Bondi. But yeah, we're kind of really committed to that cause of trying to generate safe, consistent alpha that is not driven by risk. It's not driven by liquidity risk or default risk or anything else, duration risk. It is purely driven by the application of that intellectual edge that Ying and I have been talking about.
Okay, so how does this compare to something like a term deposit, which is returning next to nothing nowadays?
Well, the first thing is you can't compare this to a TD because one's a bank deposit, one's a managed fund. The bank deposit's government guaranteed. I mean, obviously that's beneficial up to $250,000, but you're only getting 0.5%. We're targeting much, much higher returns of 1.5 to 3% above and beyond the RBA cash rate, net of fees, pre-fees even higher again. We're also targeting that running yield in the 2 to 3% zone. So I would say that you can't really compare those two investments, but certainly if you want something that sits between deposits and equities, something that's beating cash but doesn't have the same risk as the equity market, in a month like March, something that would have only been down, max 1 to 2% rather than say, 25 to 35% in the case of bank stocks, then this is a portfolio for you. Australians, I think you mentioned this, Peter, before, generally underinvested in fixed income. So Aussie self-managed super portfolios tend to have a ton of cash, and they tend to have, so bank deposits, I should say, and they tend to have a lot of direct equities and maybe some property. But they don't have much in between, which is kind of odd. If you think about CBA's capital structure, shares in CBA are the equity at the bottom of the capital stack, deposits are at the top of the capital stack, but CBA is funding itself by issuing lots of other great investments, hybrids, T2 subordinated bonds, senior bonds that are unsecured, senior secured bonds or covered bonds, and even things known as residential mortgage-backed securities or RMBS. So all those asset classes should be in retail portfolios in theory, but they're not. And that's kind of one of the problems we're hoping to solve with the Switzer Higher Yield Fund.
And tell us this, just so people can know clearly, list the typical things that you invest in. We call it a bond fund, but you've kind of made reference to bank senior bonds. You've talked about state bonds, but just give us a list of the sort of things you'd be investing in.
Yeah, things like ANZ, CBA, NAB, and Westpac senior bonds. They're the major banks and regional banks, Tier 2 subordinated bonds. All the major banks and regional bank hybrids. And then we're very focused on businesses that have effectively very little credit risk, so intrinsically low credit risk. So businesses like Woolworths and Coles or Optus. Generally they're oligopolists. That means they have a lot of market power, and they sort of fall in the too big to fail camp. So you might see Woolworths, Coles, Optus, the major banks, regional banks, Macquarie, and across their capital structure. In addition, you might also see some government bonds, some New South Wales government bonds, some Queensland government bonds, potentially some Western Australian government bonds, South Australian government bonds, even in theory, Victorian government bonds. So there's a pretty diverse array of fixed income securities. We are hedging out the interest rate risk. So we're removing the risk of the portfolio suffering losses if bond yields increase. We're removing that first order risk through hedging out the interest rate risk and making a floating rate portfolio.
So what percentage income would an investor expect on an annual basis, Chris?
Well, the target returns are 1.5 to 3% above cash. So that's the, the expected return range. The target running yield is 2 to 3%. So that's the sort of income level that you would want to try and achieve. It obviously depends on the market conditions. If we're generating a lot of capital gains, then returns can be significantly higher. Obviously, the converse is also true. And obviously, past performance is any guide to future returns, and investors should clearly read the PDS to understand the risks and, if required, seek financial advice to better understand their choices.
And how does someone invest in this fund?
Well, you can do so on the ASX because it'll be quoted on the ASX. So you can do so through a broker on the ASX, or you can contact Switzer directly.
Yeah, I'll jump in off screen.
You might want to mute.
Jumping off screen. So the process to invest during the initial offer, you fill out an application form available at switzerassetmanagement.com.au. And then the units will be quoted on the exchange, will be Chi-X as of next week. So if you wanted to apply for quoted units, just select quoted units and they'll appear in your broking account next week on the 23rd of December. So head to switzerassetmanagement.com.au and that's where you'll find the application form.
And thanks,
I should just, I just want to apologise to the audience. That wasn't Peter talking, that was actually Tom. Peter didn't just sort of undergo
somebody else. Yeah, I didn't do that.
That's right. But thanks, Tom. Appreciate that, mate. That's very comprehensive.
Well, Ying and Cheng, and who are you again? Chris Joye, aren't you? Thanks for joining us on the program. without doubt, you and I have known each other for a long time, and over the years, we've often locked horns on many subjects to the advantage of both of us. And
I'd like to think I'd have had the better of some of those debates, but you did dust me up on the RBA rate cuts about a decade ago. I know you've never forgotten that, mate.
Well, I'm actually very proud of you that you're prepared to admit it, mate, because I'm probably the only person in the country who can at least claim a victory over you. But as I say, I'm very proud to be associated with you guys in this fund, and I wish you a lot of luck. And clearly, I'll be putting my money where my mouth is as well.
Thank you, Peter.
Thanks, Peter.
Okay, thanks very much,
Thank you.
Ying and Cheng. So thank you very much, everybody. A reminder, if you would like to call back after the webinar, please click the raise hand button now, and someone will get in touch with you after the session. Now, the initial offer period for the Switzer Higher Yield Fund will close at 5 p.m. on Friday, that's this Friday, the 18th of December. As part of the relaunch of the fund, we're offering a loyalty bonus to people who invest before this date, and investors who invest during the initial offer period will be eligible for a loyalty bonus of up to 0.5% of the amount invested during the offer period payable in the first year. So to get that 0.5%, you effectively have to stay in for a year. So once the initial offer period is finished, units are expected to be traded on the exchange with the ticker code of SHYF. To invest, visit switzerassetmanagement.com.au, where you can find our online form and make payment via BPay. If you have any questions, please contact us by phone or email. The email address is invest@switzer.com.au, and the phone number is 1300 052 054. And a reminder, please read the PDS carefully before investing, and if you need any more help, go to a financial advisor and tell them what you're thinking about doing. Once again, thanks for joining us. Thanks, Chris and Ying and Cheng, and I look forward to seeing many of you in the future. Thanks very much.